At 10:01 on a Tuesday morning, a 26-year-old designer in Denver named Evan was up $2,000 on a single trade and already spending it in his head. By 10:04, he was trying to sell at any price and discovering that, for minutes at a time, no price existed. Here on Grace Investing, we care less about how people get rich than about how they get wiped out. So today, we're rewinding 3 months to watch it happen in slow motion.
3 months earlier, Evan is an in-house designer at a mid-sized company, and by night he freelances to plug the gaps in his paycheck. His anchor client is a man named Kessler, who treats deadlines as suggestions for himself and commandments for everyone else. It's almost 1 in the morning on a Sunday when Kessler's 5th revision request lands. The layout still feels cheap. Do it again. And since we keep going back and forth, I'm taking $20 off the invoice. Call it a learning fee.
Evan stares at the message for a long time, then types the only thing a man who needs the money can type. Understood. I'll have it to you by morning. When the file finally uploads, he leans back, listens to his aging laptop's fan whine, and opens his banking app to survey the damage. It isn't much of a survey, a thin checking balance, and beneath it the brokerage account, a couple of dividend ETFs he bought 2 years ago because every sensible article said to. A full year of dividends comes to about $300. The ETFs are doing exactly what they promised, slow, boring compounding. But at 1 in the morning, to a man who just paid a learning fee for the crime of being tired, it doesn't read like security. It reads like a sentence. Then the algorithm twists the knife. He opens social media to decompress and gets a highlight reel instead. A former classmate's new car, an old coworker posting trading gains, a friend's engagement photos at a resort he couldn't afford to park at. The phone dims for a second and shows him his own reflection, gray-faced, eyes swollen. That was the night patience stopped feeling like a virtue and started feeling like a trap. The push comes a few days later, at lunch. A senior colleague slides his phone across the table, a brokerage app, a green number, 4 digits. Made that this morning before the 10 o'clock meeting, he says. Evan laughs it off. He has $1,500 to his name. The colleague shrugs. You're thinking about it wrong. You don't need to be rich to trade big anymore. You day trade it, on margin. The broker lends you buying power, the colleague explains. During the day, roughly $4 for every one you put up. In and out inside one session. Settle the difference. Done. And that old rule that made you park 25 grand before you could day trade? Regulators retired it this June. To a designer getting docked $20 at 1 in the morning, it sounds less like finance and more like a cheat code. 4 to 1. Just for showing up. Evan turned the phrase over for days. To his credit, he doesn't jump. He asks an AI chatbot how margin day trading actually works, and the answer comes with a warning attached. Margin is a loan. Your equity has to stay above the maintenance line all day, and if a position collapses, the broker can sell you out without asking. And if the sale doesn't cover the loan, the negative balance is yours. A real debt, collectible like any other. Evan closes the app and doesn't touch anything. Yet. Instead, he studies the way conscientious people ruin themselves. Thoroughly. Weeks of tutorials, reading the order book, volume signals, moving average crossovers, the classic breakout entry above a prior high. Eventually, a chart lines up exactly like the textbooks promised. He breathes in, follows the checklist step by step, and places the first trade of his life. Cash only, no leverage, just the $1,500 he actually has. 12 minutes later, he's out, right at his target. Realized profit, $90. He does the conversion instantly, the way broke people always do. $90 is a weekend of revisions for Kessler, insults included, and it just materialized in 12 minutes from a checklist. Next to that, the ETF's $300 a year stops looking safe and starts looking absurd. The escalation writes itself. A few winning weeks later, on a Friday night, Kessler's next demand arrives. redo it. Young people shouldn't fear hard work. At the exact moment, the trading app pings with the day's tally, plus $510. Evan reads the message twice. Then he types, "Kessler, I'm ending the retainer. Keep whatever you feel you're owed." He hits send, mutes the thread, and sleeps like a man acquitted.
What follows is the most dangerous thing that can happen to a new trader, a winning streak in a bull market. Evan logs every trade in a spreadsheet and starts reading it like scripture. 68% win rate, stops at 2%, targets at 4%. The expected value is positive, so the math says the only missing ingredient is size. He sells the ETFs, empties his savings, adds 3 months of profits, and a detail he mentions to no one, tops off the rest from a personal line of credit, $25,000 of equity. On margin, intraday, that swings $100,000. Which brings us back to that Tuesday. A server hardware stock has been ripping for a week, every screen he follows glowing green. At the open, Evan commits to full $100,000 in a single order. The risk feels contained. He set a stop limit 2% below his entry, so the worst case, he believes, is a $2,000 bruise. By 10:01, the stock is up 2%, and he's mentally spending the profit.
3 minutes later, the market reminds him who sets the rules.
At 10:04, a well-known short-selling firm publishes a report accusing the company of faking its order book. Screenshots, whistleblower quotes, the works. Whether the report is true no longer matters. Within a minute, the stock is falling so fast it trips a volatility halt. Trading simply stops. Evan's green 2000 is frozen on the screen, and beneath it, the price everyone will accept when trading resumes keeps sinking.
5 minutes later, the stock reopens 9% lower, straight through his safety net. Because here's what the tutorial skimmed. A stop limit is 2 instructions. Sell at my trigger, but no worse than my limit. The stock never trades at his limit again. It reopens, plunges, halts, reopens, plunges, halts. Evan ends up in the office stairwell, stabbing at the sell button between freezes. And when a market order finally fills, the print reads -35. His stop-loss discipline turns out to be a seatbelt in a car that's already over the cliff. Do the arithmetic he's doing on the stairs. $100,000 position, down 35%, a $35,000 loss. His equity that morning was $25. The account now reads -$10,000, and margin math has no mercy rule. The negative isn't the broker's problem, it's a debt, and the broker's email that afternoon says so in polite, final language. There's no prison in this version, just paperwork with teeth. An unpaid margin debit gets the account frozen and handed to collections. The brokerage can sue. The collection lands on his credit report and follows him for 7 years, into every apartment application, every car loan, every background check that pulls his file. Quiet consequences. Long ones. Evan's week becomes a fundraising campaign with one donor category: desperation. He empties what's left, messages old classmates with a script of apologies, and finally opens the bank's personal loan page, the one with the interest rate you normally scroll past on purpose. He wires the balance before the deadline. No collections, also no savings, a credit line already spent, and a brand new loan on top. Late that night, he sits in the dark with what's left, $11 and a repayment schedule. He scrolls to the muted thread, stares at it for a while, and types, "Kessler, apologies for the silence. If there's urgent work, I'm available, and the rate is flexible." The little keyboard clicks are the only sound in the room. That's the story. And if it were rare, it wouldn't be worth a video. But versions of it play out every single market cycle. So let's pull out what actually went wrong here, because it was not bad luck. It was 4 separate risks, stacked on top of each other. Risk 1. A stop loss is a plan, not a guarantee. A plain stop becomes a market order and fills wherever panic prices it. That's slippage. A stop limit can skip the fill entirely when the price gaps through your limit. And while a stock is halted, no one's order does anything. In a real crash, Your discipline watches from the queue.
Risk 2. The margin bomb. Leverage multiplies both directions. Intraday buying power can run to roughly 4 times your equity, and the broker can liquidate you without asking. If the sale doesn't cover the loan, the negative balance is legally yours. And since this June, the old $25,000 minimum that kept small accounts out of day trading is gone at most major brokers. The door is open wider than ever, which makes the floor no softer.
Risk 3. You are the slowest player at the table. Day trading is zero-sum. Your gain is someone else's loss, and the someone on the other side is usually a machine with co-located servers and microsecond execution, not another guy in a stairwell. The long-run academic studies that follow day traders across entire markets keep landing in the same place. Only somewhere between 1% and 3% are consistently profitable. And risk 4. Bull markets grade on a curve. When everything is rising, almost any entry looks like skill, and beginners size up on what is actually the index's tailwind. Evan's 68% win rate was never an edge. It was weather. Short-term trading without a real edge isn't a strategy. It's a cue for the stairwell. So what does the alternative look like? Real investing is mostly reading, not clicking. It's opening the financials, revenue, gross margins, free cash flow, to check that the earnings are real. It's understanding why customers can't easily leave, which is all a moat is. And it's forming your own view of what the business is worth, so that a falling price looks like a discount instead of a disaster.
A simple filter. If you can't explain in 2 minutes why you own something, you don't own an investment. You own a ticket. And the first step isn't learning to predict the market. It's changing what you look at, from the price of the stock to the value of the business.
The market transfers money from the impatient to the patient. Evan paid full tuition to find out which side he was on. Like and subscribe if you got something out of this.